Look, I mean, it's a strange old world, isn't it? That a couple of months ago, everybody was expecting, a very serious recession, particularly in Europe. And why was that? I think the biggest component of that was the fear that energy prices would stay high and perhaps spiral out of control, given the war in Ukraine and long-term lack of investment in fossil fuels. And guess what? Actually, the market proved to be more efficient than any of us thought.
Amazing. And we conserved as well.
Yeah, I mean, perhaps a little bit of less consumption, slightly more muted economic activity, and then this sort of LNG mobile ships and things like that, and hey presto, energy prices are under control. So that's the biggest piece of the jigsaw that perhaps explains where we are. But I think the other reality is that actually the economy in other areas, I mean, people talk about interest rates and they look at one factor and they think higher interest rates are bad for economic growth. But actually, if you're a saver, higher interest rates are finally bringing you some sort of income. And where do we find most of savers, on the broad term? Places like Germany, Northern Europe. So I think these, again, sort of little factors that people have forgotten. Tourism, again, big plus for Europe. And then finally, the reality that European assets have been undervalued and under-owned for some time. So there's a bit of a catch-up trade there.
I want to ask you about that, because they have been undervalued always historically versus the US, but the disparities became even wider. So look, we never expect, I don't think realists amongst us, European valuations to ever catch up to the same levels in the US. There's a whole host of factors there, whether it's the investor pool, attitude to risk, the growth potential of the US market. But having said that, the discount was just way too high. And there's a lot of study around about it at the moment. So can Europe at the moment continue to just to converge a little bit with some of those US valuations? And my second question is, does that mean that the US goes down a bit or Europe goes up, or a combination of the two?
That is a crucial issue. I mean, I think that I talked about savers, I talked about tourism. I mean, how about luxury goods? I mean, again, looking for reasons to be optimistic about Europe. So yes, I am in that camp. I think the gap got too wide. And again, just hang on a second, let's talk about politics for a second. I mean, we don't have the most inspiring leaders here. But if you actually look at the big four...
You put a seatbelt on in the United Kingdom without thinking about it.
The big four leaders, US, UK, Germany and France, they're okay. They're not doing anything amazing, but they're not controversial. They're not causing big problems. So again, that's part of this slightly more optimistic picture. So yes, I do think that Europe, areas like financial services, European banks are still trading at big discount to book value. So there's some obvious obvious value there. So yes, I do think that perhaps a combination of the two factors. Your last sort of leading question is what's going to happen in US. I think US is a little bit of a different picture. I think the Fed has over-tightened. I think the Fed is going to overplay its hand. I think the Fed is actually behind the curve, if you'll excuse that expression. And I think the mix of the US economy was orientated far too much towards growth and, let's say, tech. I think there is a bit more air to come out of that bubble. So that again contrasts the makeup of European assets with the makeup of US assets.